What's happening, people? Welcome back to another video. I know I'm pumping these out lately. I'm just really enjoying making them, and thankfully they're getting a good reception, so I really do appreciate it. So it's looking like we're in lockdown here until the 12th of April in Ireland, so I've had to have a go at cutting my own hair. So I'm going to be staring straight at the camera because I haven't had a chance to finish the back yet. For those of you that don't know me, my name is Killian, and today we're going to be running through how to invest your first €100 or $100 or whatever currency you use. So essentially, how to dip your first toe into the market, and hopefully you'll be able to glean some value from it. If you do, please do me a favor and give that like button below a slap. It just lets YouTube know that you think I'm sound. And as well as that, subscribe. We're trying to grow the community to 400 subs by the end of February. Right off the bat, I just wanted to say I am not a financial advisor. So please do your own research into investments before taking on any risk. So without further ado, let's get into the video. We're going to start off with why you should consider investing. Well, first of all, the market has averaged 10% annual return on investment historically. Now, this doesn't mean you're guaranteed to make that, and I think a lot of retail investors do lose money if they're not careful about their investments. If your money's in a bank, you're actually losing money through depreciation, through inflation. As well as that, in Ireland, we actually make no interest on money that's sitting in the bank. In fact, we're charged on it. So you're actually losing money leaving it in the bank. A lot of brokers are offering zero trade fees at the moment, so it's very easy to get started, and it doesn't take a genius to make some returns when investing. That doesn't mean the stock market is free of risk though. So the stock market or equity market is just an aggregation of people buying and selling stocks. A share which you buy is actually just like a really small slice of a pizza, if that pizza was a company. God, what kind of analogy was that? The main reason companies sell shares is to raise capital, so to make money. And they use this money from anything like research and development to paying off their debt. So the two types of securities I want to focus on are ETFs and individual stocks. An ETF is an exchange-traded fund and is a basket of stocks to mimic a certain market sector that trades on an exchange. So they could be tracking a particular industry or a particular exchange. ETFs are a great way of investing if you've no interest in researching individual companies, and you just want to see an increase over time without having to put too much additional effort in. They're like a bundle of different investments and can help you either diversify or narrow your investments. An example of an ETF in the US you might have heard of is the SPY, and this is the S&P 500, benchmarked by the 500 most popular companies in the US. It is the most commonly traded ETF in the world, and in 2020, it saw a growth of 18%. Some ETFs pay a percentage dividend as well. So this could be anything from 0 to 4 to 5% of your investment annually. You also pay an expense ratio, which is kind of like a fee to be a part of the club. And for the SPY, this is 0.095%. These values for dividends or expense ratios will vary from ETF to ETF. A similar ETF which is available to trade on Trading 212 here in Ireland is the VUSA, which is Vanguard's ETF, which also tracks the performance of the S&P 500. Just a quick note for anyone from Ireland watching this: if you invest in an ETF that's domiciled in the US, you will have to pay income tax on the dividend, as well as paying capital gains tax upon disposal of the security, so when you sell it. I would personally like to invest in something like the Vanguard Growth ETF or one of ARK Invest's ETFs, if the option was available to me. Although the risk is higher due to the fact that they focus on growth and innovation respectively, the risk would be worth it for me. If you want to be more involved and responsible for your investments, you can trade individual stocks. I opened an account on Trading 212 on the 31st of August 2020. So I'm actually coming up on 6 months of trading now. I did this because I had been reading up on the stock market so much, watching so many videos, that I thought it was finally time for me to bite the bullet and just start before I go insane. As well as this, I saw that there was potentially big catalysts coming up for Tesla, and I wanted to get in there early. I bought 1.1 shares for €452 as I was being kind of conservative with my investing, and I wanted to be able to put money into other companies. As of recording, those shares are worth $900, so that's a nice 100% gain from me. And only recently, funnily enough, Tesla became my first stock to cross €1,000. Thank you, Elon. I love you. Now, there are a lot of other industries where you see huge gains as well over time. For example, tech was amazing in 2020. Apple are up over 65% in the last 12 months, with other companies like Microsoft, Nvidia, and Corsair also significantly increasing. This just shows that it's not just Apple being an outlier in the tech space. As I said, I invested in stocks by opening a brokerage account on Trading 212. Before buying a stock, it can be worth looking into recent news about the company as well as doing some technical analysis. Now I know this isn't going to be easy in the beginning because it's all going to be very new to you. If you do want me to talk about specific stocks that I am invested in the future, do let me know. If you are planning on investing in a company long term, finding the perfect entry point isn't going to be as important. This is because you're hopefully going to see your expected outcome over the next few years. But do remember that stocks don't only go up. You are risking your money when you invest in any company. Just a note here on Trading 212, all your investments up to £85,000 are insured by FSCS protection. So if Trading 212 went bust in the morning, your investments would be covered and you would be reimbursed. This is only if Trading 212 went bust though. If the stocks go down, you don't get reimbursed. Looking online, it looks like if you have more than that, you will also be reimbursed, but maybe not totally. A quick recommendation here is to use the limit order feature instead of market order. This just means that when the stock hits the price you want to pay, that it'll buy it for you. I've been stung before using the market order because it will just buy it at the next available value and the stock can swing big time in a matter of minutes and you can pay a much higher price than you wanted to pay. So in summary, you need to decide whether you want to be a conservative long-term investor or somebody that takes more risks in the hopes of receiving more rewards. Are you looking to do your own due diligence or do you want to set it and forget it? Off the back of those questions, you should be able to gauge whether you want to invest in ETFs or individual stocks or even a mixture of both. I believe that you should invest in something you are interested in, something you hopefully understand, and something you believe in. Let me know below if I left out your favorite type of investment, or if you'd be interested in maybe a longer form 30-odd minute video explaining more on the stock market. Thank you very much for taking the time to watch this video. I really do appreciate it. If you enjoyed or got some value, please give that like button a slap and consider subscribing. As I said, we're trying to get to 400 by the end of February. Thanks very much. I'll see you in the next one. Good luck. I guess I'll show you. Can you see it? It's not good. It'll be fixed by the time we do the next video. I promise.